To most people, the stock market still seems like a way to get rich quickly, but the reality is nothing like that. The stock market is about building wealth over the long term with the right knowledge, patience, and discipline. It is not a shortcut, because when you buy a stock, what are you actually doing? You are becoming a partner in a company, right? You are sharing in that company's growth, profits, and future. That's why the people who make the most money in the stock market are usually not the ones who move the fastest, but the ones who think the most wisely and are the most patient. Price and value are not the same thing. A stock's price may fall today, but the company's true value may actually be increasing. Or the opposite can happen. The price may seem to be rising while the company is quietly getting weaker from within. An investor who can recognize this difference moves based on their own reasoning instead of following the crowd. It's not easy, but it is something that can be learned. Most people enter the stock market with emotions and leave with panic. They see a news headline, get excited, buy in, then when the price falls, they get scared and sell. However, successful investing is built on planning, not emotion. Someone who doesn't decide in advance when to buy, when to add more, when to wait, and when to exit is not really losing money to the market. They're losing money to their own mistakes. Realizing that alone is a sign of maturity. One of the biggest mistakes in the stock market is becoming blindly attached to a single stock. No company or sector stays at the top forever. A company that's flying high today may become ordinary 5 years from now. Yes, that can happen. That's why smart investors don't put all their money in one place. They spread it across different areas. This reduces risk and prevents a single piece of bad news from shaking their entire portfolio. Think of it like not putting all your eggs in one basket. It's an old idea, but it's still valid. In the stock market, patience is even more valuable than capital. Great companies don't grow overnight, but over the years, they can produce truly remarkable results. Constantly checking stock prices usually does more harm than good, because while prices move every minute, a company's real strength isn't measured in minutes. Sometimes the best strategy is to do nothing. What really matters isn't asking, is this stock cheap or expensive, but understanding why the company is valuable. Is its revenue growing? Is its debt under control? Does it have a strong position in its industry? Does it have future growth potential? If you can't answer these questions clearly, then what you're doing isn't investing, it's simply guessing. Crowd psychology is another topic worth paying attention to. If everyone is talking about the same stock, stop and think for a moment. Most opportunities aren't where everyone is looking. They're often hidden where almost nobody is paying attention. You'll often find that big money is made in quietly growing companies that very few people are talking about. You usually won't find those opportunities in the middle of the crowd. Of course, the stock market isn't just about rising prices. Declines are also a natural part of the game. In fact, this is exactly where the difference between a good investor and a bad one becomes clear. What do you do during a downturn? Someone who sells in panic only increases their losses. Someone who stays calm and understands why they bought the stock can turn that decline into an opportunity. Before learning how to make money in the stock market, you first need to learn how not to lose money. Limiting losses is even more important than maximizing gains. Every investment made without risk management is at risk of eventually becoming gambling. That's why before making an investment, you shouldn't only ask, how much can I make? You should also ask, how much could I lose? And can I handle that? At its simplest, the stock market is about becoming a partner in the future. A company that looks strong today may decline tomorrow, while a company that seems ordinary today may become a giant over time with the right strategy. That's exactly why an informed investor doesn't just look at charts. They analyze the company, its industry, and the broader economy together. And finally, Never forget this. Success in the stock market doesn't come from one perfect prediction. It comes from repeating the right habits over and over again. An investor who keeps learning, stays patient, manages risk, and controls their emotions gradually earns a strong position in the market. Because the stock market doesn't reward the smartest person, it rewards the most disciplined one.